Right, hello everyone. You should be able to hear me. If you can hear me, type a little something in so I know that we're ready to go. But welcome to the Hurley Investments. That's the high. The Hurley Investments Market View commentary for Monday, the 23rd. Oh, finally, we got an update. And I'm going to go over three rules of trading. Thank you, Stuart, Russ, James, and Jim. A couple things have happened, and I want to go over a little something I talked about 2 weeks ago. Rules of trading. Number one, if you are short, you pay the dividend. If on the X date you have a short call or short stock, etc., 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 when your stock goes down by that amount the next day, if you are short, as in a short call, short the stock, that money goes down by your stock and gets paid out as a dividend. This is a March 17th email from MoneyBlock. Reminder for the SPY quarterly dividend, the X date was March 20th. As a courtesy reminder, please note that the SPY S&P 500 ETF will go ex-dividend on Friday, March 26th. Be cautious of all short SPY call options that are in the money or near the money. Also keep in mind that accounts can always be assigned prior to the option expiration date. If the account is assigned early on any SPY options on Thursday evening, March 19th, the result will be a short position of the SPY underlying for the open of Friday's trading session, March 20th. The account will be responsible for paying the per share dividend amount. Dividend is estimated to be between 1.44 and 1.65 per share, or $1.44 to $1.65, and is payable on April 30th, 2026. Any questions regarding this matter, please contact MoneyBlock customer service. There you go. Again, simple. If you are short a stock or short a call on the ex-dividend date, when the stock loses that value, that is a dividend that's taken from the value of the stock paid to the stockholder in the form of a dividend. It was supposed to be a 15% tax rate, much lower than the perceived earned income rate of the individual. Sometimes people have earned income rates of like only 10% and pay only 10% on taxes, which the dividend doesn't help you that much. But yes, plain and simple, if you are short a stock or have a short call or are assigned an early assignment into a short position, you are responsible for paying the dividend. You do not give it a dividend. Number two, happens all the time. I kind of giggle, but remember, you don't have a profit until you take a profit. For all of you people who have been talking about how amazing gold has been doing, gold lost 10% on a weekly run lower. Oil has taken a 21%, 19.1% drop over a week. Silver trading at 69.89. His drop down from about 135. That's at least what, 46% drop? You don't have a profit until you take the profit. For those of you that have talked to me and you're like, oh, I'm doing so well and crypto and this and that, I'm sure I sound like, oh, big deal. You're like, well, are you that profitable? And I'm like, maybe in some positions, but I don't brag about it until the profit is taken. For some of my silver people, I made the push right at around 100 and another big push at 120. And some people didn't listen. And because of that, it's kind of a bummer. It's not a profit until you take the profit. And again, if you're bragging about it, it's one of those things that you might think about, hey, you know what? Let's think about Kevin and what Kevin would do. Number 3, and this will be the last one, and I'm going to be honest with you. Yes, the market also almost broke me. 6 out of 7 weeks, the market has been down. And 4 consecutive down weeks. Now, there's something I do when the market breaks me. We add puts. We can add index puts. We can get frustrated. Like there is no tomorrow. And then I prefer to use highly technical 4-letter words like I do on the golf course. That's real life. It's frustrating. It pisses me off. Some of it doesn't make sense. Micron, fabulous earnings. Nvidia, fabulous earnings. But some of you have said, Kevin, why did you not add puts on Micron? Well, we no longer have shares. We took it out. We do have the short side of the longs. And a couple of you said, well, it's holding. I mean, it's kind of funny because we get the big down day. And I got a couple of phone calls. It's filling the gap. The reality is that's an awfully small little gap there. That's not a real gap. It's difficult. Trading is not easy. It gets frustrating. But what we were using was the 50-day simple moving average. That 50-day sits at 402 and 15 cents. It closed at 404 and 35 cents. Tomorrow for Hurley Investments will be a big day on deciding if we take some profits from our spreads, if we add a couple Micron puts for every contract spread that we have. But Kevin, This is kind of my funny one, right? But Kevin, you let it fall from 471 intraday all the way down to 404 without doing anything. The honest truth is, yes, we did. In 4 days, during an intraday high, it has fallen $67. Actually fell $50, but finished back at 448. Opened it below 448 and finished down around 425. Opened today at 425, went down to 404. We're watching it. We're paying attention to it. We know what's happening to it, but we also have a short side of your spread that, to a certain degree, is covering somewhere in that range of 58 to maybe as high as 69, 70% of the cost of the long call or the money-making side of your spread. Could we have closed things down at a higher price? Well, the short answer there is, duh, yeah, we could have. But it was an earnings. It was a great earnings. It was as high as almost or over $500 after market. Does it make sense that it has fallen down this far? Not really, but I have an article I'm going to share with you. But the short answer is we don't change the way we trade. It's still not technically bearish. So we don't guess in a single day that we need to add puts. So yes, the market almost broke me, but I follow a methodology. And because I follow that methodology, I don't just randomly throw stuff on. I don't randomly day trade. There has to be some sort of rule-based trading that you're doing other than just throwing crap at the market. And so we don't. A couple simple things that I've seen, obviously, in the past month. A couple weeks ago, I was a little harsh on a couple of you guys. I would 100% rather have you guys pissed off at me than losing tens of thousands of dollars. I appreciate our friendship. I appreciate the gift exchanges at Christmas. I appreciate the phone calls. But again, my business is run on the fact that I make you as much money as safely as possible. And when you ask me my opinion, or you tell me some things that are going horribly wrong, my job is not to kiss your butt and tell you how it just happens. My job is to be brutally honest to save you tens of thousands of dollars. And that's what I'm going to do. All right. A bunch of you has asked, just in general, what the heck is going on? And I kind of giggled because I did have this whole, well, duh, it's the Trump taco trade. And then some of you asked me, well, are we speaking to the dictator's son or not? Who's lying? Right? Let me put it this way. Who's telling the lie? I don't know. I don't know if it's Trump telling a lie. I don't know if it's the dictator that's telling a lie. But I am going to make a couple comments here. I don't like, in fact, I'll go on record saying, I hate politicians. I did like Ronald Reagan. To be honest with you, I did like Bill Clinton until I felt like Bill Clinton robbed Social Security to balance a budget. But I've liked both of those two. I really liked the second Bush that came and finished the Iraqi war. Don't necessarily like them as politicians. Each one of these men have done a couple things that I liked until they lost my trust. I really liked having a businessman treating the government like a business. I know it's hurt some of you by shutting some departments down. I also can go on record saying by being regulated by a couple government agencies that I feel those are the people that couldn't get a job in the real workforce, so they had to go to the government, and they do nothing but piss me off regulating my business when they haven't traded a single stock in their life. So let me give you my opinion, and I do not have a clear defining answer. I think it's a game. And Trump bought us 1 week to hunt down the sun and bomb. I'm going to use his own terminology. Bomb the shit out of them. Do I think they've had great conversations? No. Do I think they've had a conversation? Probably. Trump, I feel, does pay attention to the stock market. And I feel like he bought us a week that he's trying to hunt the sun down and kill him. That's common sense. It's the same common sense that you shut down the Department of Education. It's the same common sense that you run checks on all the billions of dollars that go out to these companies when they don't even have a real address. Someone made the comment, well, if we put everyone in jail, there'd be no one there. I don't care. If you broke the law, go to jail. It doesn't make sense how people that make $165,000 a year are worth millions of dollars. Go after those people first. I don't care if they're Democrat or Republican. Have them prove that they're earning that money. Keep track of where the money goes. You sure as hell can do it for us on the IRS. Do it to those that are in positions of power the same way. I would have come and told you if we were down today, Trump did a taco trade. He's trying to threaten him and it wasn't working. Well, overnight it worked by threatening to bomb yesterday the infrastructure for electricity. Did he talk to the dictator's son? I don't know. They say no, we say yes. Did it mean that we had crews or, someone talking to him? Probably. But in my hearts of hearts, as a businessman, he bought our market a week to drop a bomb on the sun and find new leadership. I'll be 100% again honest because I love it. We don't get oil out of the Strait. Saudi Arabia, the Strait of Hormuz. Saudi Arabia uses the other strait. It goes a different way. We don't get oil out of the strait. And this is probably not what you're going to enjoy hearing. I think it would be funny to leave the region and have the countries who receive this oil go about protecting the strait. But that's not fair. The United States bombed and took out a dictator and brought us this problem. Well, again, if any part of the fact is that we were willing to give them a forever supply of used uranium to create electricity, or that they did and were days away from having 11 nuclear bombs that could be active, that could have hit anywhere in Europe, where is the gratification? And where is the standing up and protecting your own countries? It's not the US's job to do or be the bully or the protector of all of these nations, to pay for all of the money we play into NATO when we can't take care of our own returning soldiers here at home. It's been nice, but it's not appropriate and it never has been. The big picture last week, Federal Open Market Committee. Houston, we have a problem. There's a big disconnect between the Fed's projections and market pricing. Rate cuts have been pushed out. The risk of rate hike is rising, driving by persistent inflation and the energy price shock. There has not been persistent inflation. Inflation has been coming down in almost all categories, except for, custom home cabinetry, blown glassware. And obviously, we just went through an energy price shock. But rising global yields and weaker treasury demands, tightening financial conditions, threatening growth, valuations, and fiscal stability. The median estimate for PC inflation this year was raised from 2.7 from 2.4. The median estimate for core PC inflation was raised to 2.7 from 2.5. And the median estimate for the real and GDP was bumped from 2.4 down to 2.3. Remarkably, or maybe we should say in explicitly, there was no change in the median estimate for one rate cut this year. That makes no sense. If you're going to change all these estimates without the data, and you can't change what you're supposed to do as a job, it's ridiculous. Ultimately, the issue isn't just uncertainty, it's inconsistency, which kind of is the theme for Powell. We're data dependent until the data changes, and then we're no longer data dependent because we're data dependent. The Fed's updated projections acknowledge firmer inflation, resilient growth, yet its rate outlook hasn't adjusted accordingly, creating a disconnect of the markets are rapidly correlating on their own. The plain and simple answer is the Fed is obviously about 1 percentage point behind the 8 ball, doesn't need to raise rates because we're already behind the 8 ball on not cutting rates, and Fed Powell has been wildly inconsistent as a Fed chair. I think we should have had lower interest rate cuts forever ago. But to protect, and you're missing me making the quotes with my hands, but to protect his legacy, he won't do anything until the new Fed chair comes in, and he can't do anything without a majority. He won't do anything with a majority vote to cut rates. We're hurting our own economy by a bloated balance sheet from a problem we had in 2008 that we spent trillions of dollars for a Band-Aid to put over it, to put over the wound, but the wound is still leaking. We're still bleeding out, and the Fed can't figure out what to do. Zero interest rates was ridiculous, and a lot of this fault can be thrown on Janet Yellen as well. But to their credit, we saw things that we had never seen before in the history of our stock market. Well, Kevin, there was the Spanish flu and, the plague of this. I get it. But in a modern era, we truly had no data to go on. So they did the best they could. Were they wrong? Maybe, kind of, somewhat, but it worked, but it's not now. It's a tough job. It's easy to pick on them. They're always a day late and a dollar short, but it is what it is. Dow Jones Industrial Average, 50.5K down to 45.4. Almost a correction from the top of February down to the bottom in March. Actually, that was an intraday just over 10% correction on the Dow Jones Industrial Average. But we are oversold. Look for a nice week this week. S&P 500, 7,002, the end of January, down to 64.73. Not quite a 700-point drop, about a 500 and something, an 8.25% drop. A pullback, but not a correction. The NASDAQ, 24,000 even, double top. End of October, end of January, like a double top, at 24 even, to a triple top at 23.6, 23.7, 23.8, down to 21.5. A 10% drop, almost a 10.25% drop. The NASDAQ was in correction territory. Kevin, how does that work? Usually a 1 to 9-ish% drop is a pullback, a 10% to a almost 20% drop is a correction, A 20% plus drop is a bear market territory. Where will the S&P end March? Again, it's kind of hard because I'm expecting a pullback. Do I think we'll get back up to even the 50-day? Probably not. So I should probably just say we're probably looking at about a 4% drop in March. Earnings, GameStop, KB Homes, and Fuller Homes. Not a whole lot of economic reports, construction spending, productivity unit labor costs, NBA current account balance, initial continuing claims, Michigan sentiment. I do think it's rather interesting. Again, this is the beauty of having a profitable businessman as a president running our country as a business, trimming the fat. He chose a week to give Iran a break when not much economic reports was going on that can allow our markets to recover. On Friday, we're going to take a super hard look at protecting for the following week, just to make sure that if it falls back down because we don't come to an agreement, because over the weekend we kill the guy, we're going to look at it as that regard. If anyone chooses to disagree, please email us. Please call us and talk to us. I have 2 weeks worth of very interesting got to change this. Kevin, you just said it was going to go higher. Going to go higher in big letters. I've got 2 weeks of very interesting economic. Looking to protect Friday or when nothing gets resolved or we bomb. Very interesting about these record redemptions. Someone talked to me about OWL and some of these regionals, and yes, they should have done really good. Regional banks should still do really well, but private investment, regional, medium to small guys are in deep trouble. OWL has a really good chance of going bankrupt. HubSpot has a really good chance of going bankrupt. You're going to see more and more redemptions stopped, and you're going to see a huge drop in these private credit funds that are happening. Expect to see some of them go out of business. OWL, if you thought OWL was going to $50 and someone talked to me about it and I didn't like it back then, and I think I have the proof now on why you should never have gotten in it between 18 and 20 bucks. Exit. Get out of it. Be worried about it. We've already had the collapse of Tricolor First Brands. More are going to come. If it catches you by surprise, you should know better. This was a couple weeks ago about the economy as a State of the Union's deadline for Trump in 2 weeks. It doesn't affect our oil supply. Saudi Arabia goes the other way. I do again think it's time, if you don't want to help, protect the strait yourself. I would really love to see that happen. Someone just made the comment, just like SPACs. Yes, I also think SPACs are in trouble. SPACs are not a wise investment. They are not a cash register ATM that just pumps out money. There is ridiculous amounts of risk in a SPAC. Over 50% of them go belly up. They are a really, really, really poor investment. Just like SPACs, it's not a wise investment for us. And that us includes myself. It includes all of Hurley investment clients. But this is about 2 weeks old. I just wanted to give you guys some information on why things are important. Just read it and learn. Top Wall Street analysts are confident about long-term prospects of these 3 stocks, yet they list about 8. The first 3, Netflix, Alphabet, and Amazon. We're in the first 2. Obviously, this Wall Street tipranks.com staff does not do his homework. He does not run fundamentals. He is not smart enough to figure out Amazon and Spotify are in trouble. Netflix, Alphabet, DoorDash, pretty good. Amazon, Spotify, tipranks.com staff member, you're an idiot. Paramount, Skydance, they apparently like. DoorDash, where's it? Oracle, apparently like Oracle as well. I enjoyed reading it. The inconsistency of research is astounding. Tip ranks, you roll the dice, whatever stocks they say or what they do, not a reliable source. Again, I'm shocked. I'm shocked by the stupidity of the American public. Tax-resistant gains amid ICE protests, Iran war, and IRS penalties could follow. I just kind of giggled because now some people are tax protesting and are not paying their federal income taxes because we are in a war and ICE is bad. And they think somehow the federal government cares. The penalties and the interest for not paying over a year, if you owed $8,000, expect to pay $16,000. With all due respect, please don't do this. Please don't not pay your taxes because you think that the government cares and that they're going to notice. All you're doing is giving yourself a bigger tax bill to pay the government that apparently you're pissed off at. Where the hell is your common sense? I don't get it. Odds of a Fed rate hike in June are now higher than the chances for a rate cut. Duh. Read through the numbers. It makes common sense to me, but we will see. Kevin, why do you not like Amazon? Because I work the numbers. Because they weren't profitable forever and people still were throwing money at them. My job is not to put you into an investment that's making money that's not financially sound. My job is not to gamble with your funds. My job is not to put into something as fiscally irresponsible as Amazon just because they're going up. This is an excellent article to talk about why you're going to see contracts pulled from Amazon when they already can barely make anything delivering packages for free. Please read through this article, but I have not put you in Amazon ever, even though I enjoyed and would have loved to see us make that kind of money. It would be fiscally irresponsible for me to gamble your money on Amazon because it's fundamentally not sound, even though it has made money. That is not my job to gamble your money. Excellent article that explains it. I love this article on NVIDIA. It's the same problem we're probably having with Micron. The law of big numbers. Again, people are stupid. Money managers are stupid. Models are stupid. Theories in Wall Street are stupid. Right now, there is a problem with both Micron and NVIDIA. The belief is a stock price will double when their market cap doubles. That is not true. That is just as wrong as all of these models that give average rates of returns and compounding interest on a variable market. This clearly defines that people think NVIDIA will have to double its stock price if all the models that are there see a doubling of their market cap. It's really hard to see NVIDIA with a market cap of $9 trillion. The models can't compute that. It's really hard to see a $2.5 trillion Micron market cap turn into a $5 trillion market cap. Because it's SRAM and DRAM. It's a commodity. The law of big numbers have caught up to NVIDIA and Micron. We knew the problem with Micron was already happening way back when, but man, they delivered an amazing return. I mean, the numbers for Micron were ridiculous. They should be a $550 stock. But the models, the theory of Wall Street can't calculate a doubling in price is based on a doubling of market cap. That is not true. It's never been true. So if you ever wonder why you've heard me rag on Vanguard, you heard me rag on mutual funds, you heard me rag on financial planning, long-term, wholesale life, universal life, barring from those type of investments, annuities, the models are broken. The numbers don't add up, but we keep using them. It doesn't make sense. Finishing up here, Goldman sees the risk of market correction rising. This came out March 19th. We hit some of these corrections in, I think last Friday. So the Friday after on the Russell 2000 tanked. NASDAQ, it's kind of one of those duh, but now we have it in writing. Oh, little surprising. The bonds won't help weather it. Well, wait a second. A 60-40 portfolio is supposed to give 40% in fixed assets that protect the 60% in risky stocks. Goldman has preached this for 50 freaking years. And then publish, by the way, the bonds won't help you weather it. We put 40% in fixed income that comes nowhere close to growing like the 60% in the stock market. that sat through 10 or 11 years with a 0 to 2.3% return. And we're now going to tell you the bonds won't help you weather the small drawdown in your stock positions. Please read this article. I feel like for years I've been preaching that, and I feel like for years some people are scratching their heads going, Kevin, you're an idiot. We have not the biggest, because the biggest is actually Vanguard, but we have one of the biggest money management funds in the world telling you that a 60-40 portfolio for a drawdown of anything more than 3 to maybe 4.2% for a year is not protected by these bonds that have missed 23 of the last up years in the or yeah, 1, 2, 3, have only helped twice in the last 26 years and missed 20 of the 26 up years that you could have had that money in the S&P 500, but some idiot sold you on a 60-40. And the people that are selling this are now telling you it won't help weather the corrections or the downturns. Please learn from it. And last but not least, I kind of giggled on this one because I've done it. Lady owned 5 rental properties, lost 4 out of the 5. Bay Area, California, where the properties just go crazy. I will never rent again. For 9 years, I hardly made anything on my rental. Renters are like pets. They destroy everything. They're like small kids. They unintentionally destroy everything or intentionally destroy everything. My growth was on staying in the property for 9 years and the value of the property increasing by 100 grand. For 9 years, I could not really make anything on real estate. A great article that I've tried to explain to everyone in the past is right here. And here's my last article. I'm picking on Vanguard. Vanguard settled to the tune of tens of millions of dollars on, and I highlighted it down here somewhere, on the implications of passive income investing don't work. Based on a small portion of time, but when it comes down to it, passive investing and the $12 trillion these guys passively invest don't work. Questions? I had a couple questions that I missed for you guys. I will get this uploaded relatively soon. What questions are we looking for? I should take this. That's how I'm looking to trade. Lee, I will get to your question there. The share moves affects our oil because it produces light crude, but our refineries are designed for heavy crude. Again, that is not, that is correct, but the Strait of Hormuz does not affect our oil production because where do we import our extra light crude that we cannot produce ourselves? Does anyone know? Maud, I'm expecting you to throw an answer in here. Where do we import the majority of the extra light crude that we cannot produce or refine or get out of the ground ourselves? What country do we get the extra light crude that we need from the lack of our own refinement? Maud, hurry up and tell us. Somebody take a guess. Canada! It comes from Canada. We pull the majority of our light crude. And it's interesting because when you go through the numbers, it's kind of hidden. There's actually 6 or 7 different types of fuel, airline, like, and the airline fuel comes from the refinery process. But we pull our extra that we need or that we don't produce through light crude and our refinery process, we actually import from Canada. I don't know what we're doing with the Venezuela oil because that's technically not ours. But when you go through the 7, I'll find it for next week. When I do the refining process, there are like 6 or 7 different fuels that are refined out of a heavy crude barrel. And you can actually produce light crude out of a barrel of heavy crude. I'm going to find that to show you what the refining process can produce out of 1 barrel of heavy crude. And it's pretty neat to be talking about it. All right. Abraham, we're gonna get this session up sometime tonight. I'm working with my son to have that happen. He's now doing all of the uploading. If puts are protecting positions, would you expect account declines to be in line with the drops in the market indices? So Nathan, that's a very interesting question. Not necessarily, because the reality is you'd want to be looking at more of the NASDAQ, not necessarily the drops in the market industries, because we're trading individual stocks. Our individual stocks, I mean, Micron's down $66. Google's down 12.5%. Apple's down 16.5%. Nvidia, pretty fat. Palantir is down 35% at one point in time. So no, we're not looking at puts that are now equal to declines of drops in market indexes. We look at each individual stock, and we actually, to a certain degree, we never compare, which isn't necessarily true either, but we're not comparing accounts to the drops that we see on the Dow. No one really trades the Dow. Irrelevant. We're judged against the S&P 500. So you should, unfortunately, you could look at us against the S&P 500. Hey, are you down like 8.6%? Do we trade mostly NASDAQ stocks? For the most part, because we've been following the Magnificent 7, then the 11, then the 19 or 17. We're really looking at the positions individually and judging how well we're doing in our positions off of a $66 drop in Micron, off of a 16.5% drop from Apple, a 12.5% drop from Google. So I hope that answers your question, Nathan. And I also think, to a certain degree, we've been nibbling right now with Brian, trying to make sure we don't just throw your money all in at once, but finding great opportunities and nibbling along the way. Thank you, Nathan. I appreciate it. Thank you, Victoria. Thank you, Abraham. Any other questions I can answer for you guys? Any other questions? Going once? Going twice? Waiting to stall for one more question. But all right, guys, hey, have a wonderful evening. Appreciate you guys being here. I do hope this is helpful for you. I hope this is an education part at the start. I hope it's helped to see what we're doing in your portfolios in the middle. I hope it helps you to look at the market and where it's moving to. I hope it helps that we're showing positions and how we've set up positions to protect you along the way. Guys, I appreciate you being here. We're going to get this published as quickly as possible because there's some great articles for you guys to read. I look forward to seeing you guys next week. Let's look for a nice up week until we got to protect on Thursday or Friday, and until we probably bomb and kill this guy and look for another leader. Have a good evening. Look forward to talking to you next week. We're always watching so you don't have to, and I will see you next week. Bye-bye.